One of the biggest paradoxes in all of investing. I mean, decades of research show that global diversification is literally one of the smartest things you can do with your money. And yet, most of us, we just keep it all right here at home. So we're going to dig into why that is, and why the most boring strategy might actually be the most brilliant one you ever adopt.
Seriously, just stop and think about that for a second. Your job, your house, and probably, almost certainly, the bulk of your retirement savings, they're all tied to the fate of just one single economy. It's a huge concentrated bet. So today, we're going to explore why we all make this bet and how a strategy that feels, well, a little boring might just be your most beautiful move. Okay, let's get right into it. This thing we all do, this tendency, it actually has a name, and it's a really powerful psychological trap that investors all over the world fall into. It's called the home country habit.
So what is home country bias? Well, it's pretty simple. It's the idea that we just prefer what's familiar. You see US companies every day, you use their stuff, you hear about them on the news constantly, so of course, we invest in them. But here's the thing, this isn't just an American habit. Nope. Investors from South Korea to Germany, they make the exact same mistake, often ignoring a whole world of opportunity just sitting right outside their borders.
And that, right there, is the multi-trillion-dollar question. I mean, for 50 years, pretty much all of financial theory has proven that spreading your investments across different economies boosts your returns and lowers your risk. So if the data is so overwhelmingly clear, why does our actual behavior tell a completely different story? Let's take a look at the evidence.
The power of going global becomes crystal clear when you look at the last 25 years. It's really a tale of two very, very different decades for the US stock market. Okay, so first up, let's talk about the period from 2000 to 2010. People call it the lost decade for US stocks, and for good reason. After 10 years, through the dot-com bust and the great financial crisis, a portfolio that was only in the S&P 500 made, well, basically nothing. It was flat, zero. But a simple 60-40 US and international portfolio, it returned a positive 35%. That is the power of not having all your eggs in one basket. Now, I know what you're thinking. Yeah, but the US market has been on an absolute tear recently. And you're totally right. From around 2015 to 2025, the S&P 500 has been a rocket ship, returning about 11% a year. The diversified 60-40 portfolio is just a little behind at about 9.5%. Now, you might look at that and think, see, I lost out. But that number really doesn't tell the whole story. Because here's the real kicker. During the big, scary market drops in that same period, the diversified portfolio fell 4 to 5 percentage points less than the US-only one. And that's not just some number on a spreadsheet, right? That is the emotional cushion that keeps you from panic selling at the absolute worst possible time. It's what keeps you in the game.
To really get a grip on the risk of piling all your money into one country, let's switch things up. Let's take a look at this from the outside in.
All right, let's play a little game. Imagine you're not in the US. Instead, you're an investor living in Seoul, South Korea. You live there, you work there, and you decide, you know what, I'm going to put all my savings into my local Korean stock market.
And wow, this chart really puts that risk into perspective. The US is a giant, right? It makes up almost half of the entire global stock market. South Korea, just over 1%. Betting your entire future on that tiny little slice? That is a patriotism. It's a massively concentrated bet that ignores literally 99% of the world's opportunities.
And it's not even just about the stocks themselves. It's also about currency. So back in the 2000s, a weak US dollar gave American investors who owned foreign stocks a massive 50% tailwind on their returns. It was like a huge hidden bonus. On the flip side, a strong dollar in the last 5 years gave that Korean investor we talked about a 33% boost on their US investments. It's this powerful extra layer of diversification that most people just completely forget about.
And looking ahead, right now, there's a pretty big valuation gap. The easiest way to think about the PE ratio is like a price tag on stocks. Right now, US stocks are trading at around 22 times what they're expected to earn. But stocks in the rest of the developed world, they're priced much, much lower, at about 14 to 15 times earnings. Now, that doesn't guarantee anything, of course, but it definitely suggests that some of the better bargains might just be outside of the US right now.
Okay, so we've talked about returns, we've talked about risk, we've talked about valuation. But honestly, the single biggest benefit of global diversification isn't financial at all. It's psychological. It's all about starving that little gambler that lives inside every single one of us.
So this is the question you have to ask yourself. Who are you? Are you a gambler, always chasing that next quick thrill? Or are you an investor, playing the long game with discipline and a whole lot of patience? Let's take a look at the playbook for each one.
The gambler. We all know this person, right? Maybe it's even us sometimes. They're drawn to the excitement, day trading really volatile options in crypto, piling into those crazy leveraged ETFs that promise double or triple the daily returns. They're chasing a thrill, right? A huge score. But let's be honest, these are stories that very rarely end well.
The investor strategy, on the other hand, is the polar opposite. They are diversified, and not just in the US, but globally. They have a long-term horizon. But most importantly, they accept a fundamental truth, that truly smart investing is often really, really boring. It's about having a plan and just sticking to it, especially when it's not exciting.
And this really brings us to the core idea of this whole thing. Maybe we need to completely redefine what a successful investment journey is supposed to feel like. We're all conditioned to want excitement, to chase the action. But what if the real goal is to avoid it?
Think about it. A globally diversified, balanced portfolio that doesn't cause these wild emotional swings, it isn't broken. That lack of a racing heart, that is the entire point. That's the feature of a well-designed plan, not a bug. And it's the very thing that lets you sleep at night while your money quietly goes to work for you.
The legendary investor Peter Lynch absolutely nailed it. He said, investing should be more like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas, If you want a thrill, the stock market is the wrong place for it. But your serious money, your actual future, make it beautifully boring. So I'll leave you with this one question. Take a moment and look at your own investments. What are they really designed for? Are they built to give you a rush of excitement, or are they built for steady, long-term success?